So Barclays just posted an £8.2 billion quarter and handed a £500 million straight back to shareholders.
Right, which is just massive.
Yeah. But at the same time, they're casually eating a near £250 million loss on just a single client and writing a £430 million check for a regulatory fine.
It's a lot to unpack.
It really is. Welcome to today's deep dive. We are looking directly at the official Q1 26 results announcement from global banking giant Barclays PLC.
And honestly, if you're trying to understand where global capital is flowing right now, this is the place to start.
Exactly. You don't need to listen to pundits guessing about the macroeconomy. You just need to look at how a massive interconnected institution like this is actually moving its money around.
Yeah, you might think a quarterly bank earnings report is just, a wall of numbers. But it's actually a scorecard for the global economy.
Right.
You're basically looking at a global heat map of financial confidence, covering everything from international merger activity to, well, the actual strength of the American consumer.
So our mission today is to give you the ultimate shortcut to being well-informed on this specific quarter, which is the period ending March 31st, 2026.
Bypassing all that standard public relations spin, right?
Right, exactly. We're going straight into the mechanics of how Barclays is navigating a remarkably complex global environment because, on the surface, the numbers are undeniably strong.
Oh, absolutely.
But the underlying machinery tells a much more nuanced story about risk and strategy. So let's start right there with the macro picture. Top-line income grew 6% year-on-year to £8.2 billion.
Which is just a huge top-line figure.
Yeah, and their return on tangible equity, the RoTE, hit 13.5% for the quarter, plus earnings per share grew 8% to 14.1 pence.
And we should note that every single business division delivered double-digit returns.
Yeah.
You rarely see across-the-board performance like this without some structural advantages playing out.
No, you really don't. They even reiterated their long-term targets, saying they want greater than 12% RoTE in 2026 and pushing past 14% by 2028.
But I think the data point that immediately grabs your attention is that fresh £500 million share buyback.
Yeah, let's talk about that. It's like a marathon runner who finishes the race looking perfectly fine and then casually announces they're going to run another 10K.
That's a great way to put it, and we should contextualize that too. This new $500 million is layered on top of an ongoing £1 billion buyback program they initiated back at the end of 2025.
It's just a massive flex of corporate liquidity.
It really is.
So, okay, they're handing a £500 million back to shareholders. For the listener trying to read the economic tea leaves here, what does this tell us about the bank's confidence?
Well, buybacks are basically the ultimate indicator of a robust capital position. From an analytical standpoint, handing a £500 million back right now is a very deliberate signal.
Like they're showing off a bit.
Basically.
Yeah.
They are telling the market, hey, we have thoroughly stress-tested our balance sheet, we see the geopolitical risks, we know what central banks are doing, and we still have more capital than we know what to do with. Yeah, it's a mathematical reflection of their CET1 ratio. That stands for Common Equity Tier 1.
Which is essentially the bank's core equity divided by its risk-weighted assets, right? Like the ultimate shock absorber against financial disaster.
Precisely. And Barclays reported the CET1 ratio of 14.1% before this new buyback, and then 13.9% after factoring it in.
So they're still right up there.
Exactly. That places them right at the absolute top end of their target range, which is 13 to 14%.
And they're committing to return over £10 billion to shareholders between 2024 and 2026.
Right. And you do not make a multi-year commitment like that unless your models show supreme resilience against macroeconomic turbulence.
But, you can't fund that kind of aggressive capital return without an engine running incredibly hot somewhere in the background.
No, you definitely need a serious profit engine.
Right. So to understand where this cash is coming from, we have to look at the Barclays Investment Bank. And this is where the narrative sort of shifts from slow and steady banking into the high-wire act of global finance.
It really does. The investment bank generated over £4 billion in quarterly income for the very first time. That's up 4% year on year.
Which is a massive threshold, and the underlying drivers there are particularly interesting, right?
Very. Investment banking fees were absolutely booming. Advisory revenues were up 78%, and equity capital markets were up 31%.
Wait, 78%? That tells us a lot about corporate boardrooms right now.
It really does.
Hmm.
A 78% jump in advisory fees means there is a massive release of pent-up demand for mergers, acquisitions, and corporate restructuring.
So companies are basically tired of waiting for perfect macroeconomic conditions and are finally just executing on strategic deals.
Exactly. They're making moves.
But hold on, let's unpack this. Because while they're breaking revenue records, we really need to talk about that very expensive stub toe buried in the credit impairment line.
Yes. The impairment charge.
Yeah, credit impairment charges for the group jumped to £823 million. And that was largely driven by a massive £228 million single-name charge in the investment bank.
Yeah, that is a number that stands out, even on a multi-billion-pound balance sheet.
I mean, when I look at a £228 million loss on a single client, my first instinct is that risk controls fundamentally failed.
It's a natural reaction.
Right. We aren't talking about a pool of retail credit cards defaulting.
Mhm.
We're talking about an institutional counterparty blowing a £250 million hole in the quarter. Isn't a mistake of that magnitude a massive red flag for their risk management?
Well, it's a valid critique, but we have to look at the structural realities of prime brokerage and institutional financing.
Okay, break that down for us.
Sure. When a bank is servicing highly leveraged hedge funds or massive corporate clients, the scale of the capital deployed is just enormous.
Right, it's not normal consumer money.
Exactly. If a client's highly concentrated position goes sideways during a period of extreme volatility or, say, a margin call isn't met, these are the kinds of numbers that materialize.
Oh, wow.
It just highlights the inherent volatility of the business model. It's a high-wire act.
So it's less about avoiding single-name risk entirely and more about pricing that risk into your broader operations.
Precisely. Because if you look at their equities division, income there was up 16% to over £1.1 billion.
And the report attributes that to growth in prime financing and elevated volatility in derivatives, right?
Yeah. They are essentially making so much money off the broad market volatility that they can absorb a £250 million counterparty blowup as just, a cost of doing business.
That's wild. It's all about portfolio balance.
Exactly. That is the exact portfolio approach they rely on. The massive gains they generate in these high-velocity market activities provide the buffer for those isolated credit shocks.
Which also explains why they're so keen on maintaining that 14.1% CET1 ratio we talked about.
Right. Furthermore, they aren't ignoring the broader systemic risks either.
Yeah, the Q126 report notes they proactively set aside an additional £52 million as a management adjustment, specifically to capture increased downside risk from ongoing geopolitical uncertainty. They are actively provisioning for what they can't predict.
So if the investment bank is their high beta growth engine, out there navigating margin calls and geopolitical shocks, they need a low beta ballast to keep the whole ship steady.
A steady foundation, exactly.
And that brings us to their domestic foundation, the UK banking divisions. And the numbers here are remarkably solid.
They really are holding up well.
Barclays UK income increased 9% to £2.26 billion, and the UK corporate bank increased 10% to £530 million.
And a significant driver of that stability, which the report specifically highlights, is something called structural hedge income.
Right, and I want to break down the mechanics of that because it is crucial for anyone trying to understand how banks actually survive rate cycles.
It's a great concept to understand.
The structural hedge is essentially how a bank immunizes itself against interest rate swings. They basically swap short-term variable rates for fixed rates. Yeah, and by doing this aggressively over the last few quarters, they've effectively locked in the higher yields of recent central bank rate hikes.
So even if the Bank of England slashes rates aggressively tomorrow, Barclays has already baked a multi-year income buffer into their balance sheet.
Exactly. It transforms highly unpredictable variable income into a smooth, predictable runway.
Which is exactly what you want from your domestic banking arm.
Right. When you have a massive deposit base in the UK, managing the duration risk of those liabilities is how you ensure consistent quarterly returns, regardless of what the central bank decides to do.
But the UK side of the business isn't entirely without its drama right now. There is a massive regulatory speed bump happening, and Barclays is right in the middle of it.
Ah, yes. The motor finance issue.
Right. On the end of this reporting quarter, the UK Financial Conduct Authority, the FCA, published final rules for a massive industry-wide motor finance redress scheme.
This is a legacy issue that is forcing a major reckoning across the entire British financial sector.
Here's a context for you. From 2003 to 2019, Barclays provided UK motor finance through a subsidiary called Clydesdale Financial Services.
And the FCA's investigation centered on something called discretionary commission arrangements.
Yeah, to understand this, you have to look at how the brokers, the people actually selling you the car, were getting paid by the lenders.
Prior to the ban on this practice, lenders allowed brokers to actually adjust the interest rates offered to customers.
Right, and the higher the interest rate the broker convinced the customer to accept, the larger the commission the broker received from the bank.
The structural incentive there is pretty obvious. The FCA concluded that this mechanism inherently incentivized brokers to artificially inflate borrowing costs for consumers.
Leading to widespread overcharging.
Exactly.
And the financial fallout for Barclays here is significant. In Q126 alone, they added £105 million to their provision for this issue,
Bringing the total amount they have set aside for this specific regulatory fine to £430 million.
But here's the fascinating part of the report. Barclays explicitly states that they strongly disagree with the FCA's methodology.
They claim on the record that their customers suffered no demonstrable financial harm.
Yet in the very next sentence, they confirm they are choosing not to fight the rules in the interest of a swift resolution.
It's a really interesting move.
I mean, to me, it's like getting a hefty parking ticket that you absolutely know is unfair, but you pay it anyway just to avoid the headache of going to court.
That's a perfect analogy.
But if they are so sure there was no demonstrable financial harm, why just roll over and accept a £430 million bill?
Well, it is an exercise in pragmatic corporate finance. If they truly believe there was no harm, taking a £430 million hit does seem counterintuitive.
Right.
But you have to weigh that against the cost of a protracted legal war with your primary domestic regulator. It's more about protecting their valuation than just avoiding a headache.
Because markets despise uncertainty. Right.
Exactly. If Barclays entered a multi-year litigation process with the FCA, analysts would constantly discount the bank's stock price to account for the unknown final settlement.
So the stock would just suffer anyway.
Yeah. By taking the hit now, they put a firm box around the liability. And this provision actually factors in a minimum of 3% per annum in compensatory interest to the customers, plus administrative costs.
Oh, I see. So they have completely quantified the worst-case scenario. It clears the balance sheet of the unknown.
Right. And the report even notes they expect other third parties in the industry to legally challenge the SCA anyway.
Oh, that's clever. So Barclays is basically letting their competitors spend the legal fees and the reputational capital fighting the regulator.
While they write the check, clear their books, and just move on. It is ruthlessly efficient.
That is ruthless, which perfectly positions us to look at where they are deploying that efficiency next. Because while the UK is their foundation, their strategy for future growth requires us to look at a completely different arena.
The highly competitive U.S. consumer market.
Exactly. And this is perhaps the most revealing strategic pivot in the entire earnings announcement. The baseline metrics for the U.S. consumer bank are already highly lucrative.
Very much so. Income increased 14% to £983 million.
And their net interest margin, which is the spread between what they pay for funding and what they charge on loans, was a massive 12.76%.
For context, a typical UK retail margin sits somewhere in the threes. So the U.S. consumer credit market is just incredibly profitable.
But Barclays is executing a massive shuffle in how they access that market starting in Q2 2026.
Right. They are fundamentally restructuring their asset mix.
They are exiting their co-branded credit card partnership with American Airlines.
Which is huge news on its own.
Yeah, and that exit generates about a $300 million gain. But more importantly, it releases roughly $5 billion of risk-weighted assets.
And at the exact same time, around May 2026, they are taking $800 million and acquiring a company called Best Egg.
Best Egg?
Yeah, which is a direct consumer personal loan origination platform for prime borrowers.
So what does this actually mean? They are dropping a globally recognized, prestigious brand name, like American Airlines, and taking that capital to buy a loan platform called Best Egg.
I know, it sounds counterintuitive.
Why trade airline miles for personal loans?
Well, to really grasp the magnitude of this shift, we need to look at how capital requirements actually dictate bank strategy. We mentioned risk-weighted assets, or RWAs, earlier.
Right.
These aren't just an accounting metric. They're basically the governing physics of a bank's balance sheet.
So think of their capital like a tight regulatory budget. An unsecured, co-branded airline credit card portfolio is incredibly capital intensive, right?
Exactly. It eats up a massive portion of their allowed risk capacity.
So exiting the American Airlines partnership immediately injects $5 billion in liquidity back into their regulatory checking account, so to speak.
Yeah, it gives them immense agility.
Yeah.
But the question then becomes, why deploy that freshly released capacity into a platform like Best Egg?
Right. Why trade the prestige and that massive customer funnel of a travel brand for a digital personal loan platform?
It comes down to margin control and customer ownership.
Ah, of course.
In a traditional co-branded credit card relationship, the bank is essentially a utility provider. The airline holds the loyalty data, dictates the terms of the rewards, and extracts a massive share of the revenue generated by the cardholders.
So the bank takes on all the credit risk, but has to split the upside with a very powerful middleman.
Precisely. But by acquiring Best Egg, which the report notes comes with about $500 million of goodwill and intangibles, they're completely changing that dynamic.
Because Best Egg targets prime borrowers directly, right?
Yes. These are individuals with strong credit profiles seeking personal loans. By owning the digital origination platform directly, Barclays cuts out the middleman entirely.
So they capture the full interest rate spread.
Yep. They own the technology stack, they own the proprietary underwriting data, and they own the direct relationship with the consumer.
That makes a lot of sense. They are deliberately trading the heavy capital requirements and shared revenues of a legacy airline partnership for a lighter, more agile, direct-to-consumer fintech model.
It allows them to originate higher margin loans without having to subsidize anyone's frequent flyer miles.
Wow. When you pull all of these threads together, you get a remarkably clear picture of how global capital is positioning itself for the next few years.
You really do.
I mean, Barclays is printing an £8.2 billion quarter and returning immense amounts of capital to shareholders. They're maintaining a 14.1% shark absorber while letting their investment bank hunt for high volatility yields.
And easily absorbing a £228 million counterparty loss along the way.
Right. They are using structural hedges to lock in domestic UK profits, efficiently paying off a £430 million regulatory fine just to keep the runway clear.
And aggressively rotating out of legacy U.S. partnerships to buy highly profitable direct-to-consumer digital lending platforms.
So, if you are managing your own portfolio or just trying to gauge the health of the broader economy, watching what a Tier 1 bank actually does with its capital is far more telling than any macroeconomic forecast.
Absolutely. Barclays is actively positioning for growth.
Right.
Their aggressive pivot into U.S. consumer personal loans via Best Egg and their confidence in massive share buybacks tells you that their internal models do not forecast a catastrophic collapse of the consumer or corporate environment.
They are pricing in geopolitical risks, certainly, but their core actions demonstrate a strong belief in fundamental, ongoing economic resilience.
They see the vital signs of the economy and they are doubling down.
They really are. But, there is one final detail buried deep in the forward-looking statements of this Q126 report that I want to leave you with today.
Well, this is a good one.
Yeah. Amidst all the disclosures about interest rate risks and geopolitical uncertainty, Barclays specifically calls out the operational risks and the integration of new technologies.
Explicitly naming artificial intelligence.
Right. Which is the defining operational challenge for the next decade of financial services.
Without a doubt.
Think about what we just discussed regarding their strategic pivot in the United States. They are rotating away from traditional credit card models and spending $800 million to acquire a digital direct-to-consumer loan origination platform.
And those digital platforms live and die by incredibly sophisticated, automated underwriting algorithms.
Exactly. Algorithms that determine who gets capital and at what price.
Yep.
So if centuries-old legacy banking institutions are now absorbing agile fintechs to originate their loans, well, how long until the algorithmic model deciding your financial future knows more about your behavioral spending trajectory than you do?
That's a slightly terrifying thought.
It is something to keep in mind the next time you apply for credit online. That's all for today's deep dive. We'll catch you next time.